run on oil-based fuels. So I think that's kind of where we stand today in evaluating, investment in the energy space. And, I think investors are highly sensitized to the fact that we've had underperformance on the fossil fuel side, and that there's been a lot of volatility, and that's making it hard for, sort of diehard investors to sort of sell the space on the street.
So I feel like we're in this weird dynamic whereby you still have a lot of, and we're going to get into this more in the panel session, but on the one hand, I feel like you still have a lot of, particularly, long-term institutional investors who have skepticism about, not climate change per se, but how to respond to climate. Maybe are not clear on how they should respond to climate change, and are still, you and I disagree to this a certain extent, like I still have questions about renewables, and yet you've seen this run up in renewables to the point where it almost feels like maybe that's a bubble, certainly if you think about companies like Tesla. So there's this dynamic whereby people feel like investors generally many investors don't have a clear vision of what they want to be doing in terms of renewables, and yet simultaneously there's this sense that the train has left the station and they've missed it. So how do they square that circle?
So what I would say is there was a lot of skepticism about clean tech, but a lot of the people who lost money in clean tech lost money in biofuels, which is an area that really didn't have much potential. And in the real asset space, investors that pick like batteries and some of these other more forward technologies have actually done well. If you talk privately to the majors from Europe that have invested both in the clean tech space and in oil and gas, they will tell you privately, as they've told me, that they've actually done better with their clean tech choices than they have done in their oil and gas space. And I think that is reflective of, the growth that we've seen in renewables, in many different markets. And, when you look at a company like Tesla, I wrote about this in a recent op-ed, you're picking a Tesla, the same reason why you're picking an Amazon. You're betting on technologies that might be cross-cutting and might go beyond the energy sector, or in Tesla's case, beyond the car sector. So Tesla has a battery technology that uses a liquid coolant, and they have used that battery to do backup for wind in Australia, for solar in California, successfully. And it's not many other battery technologies. You have a diesel fuel pump that's, keeping the battery cool if there's some kind of heat wave. And so Tesla has a superior technology. And then they have other technologies. I don't think many people are aware, but the car has some unbelievably high-end HEPA filter that's designed to help you in a terror attack. But, in today's world where everybody's worried about the HEPA filter in their buildings and so forth, the fact that Tesla has an advanced HEPA filter technology, that could have applications that go beyond the vehicle, right? So I think that people are making these technology choices, and to the extent that you get a company like a BP or Total that are oil companies, but they're basically starting to make technology bets. Given the fact that they're technically able management and they've signaled their interest in investing in technologies, I think the market's a little bit behind the scenes is tagging them as a fossil fuel company, because really, the thing that can make a difference, and we've seen this in the markets, is, people want to be an early investor in a technology that's going to take off, right? So like I like the hydrogen electrolysis space, even though it's really early days. Shell is investing heavily to do that with offshore wind in the Netherlands. I like that space. I think that's going to be a growing space, and right now it's cost handicapped. But as it scales up, I think it could be like solar PV, where the costs for the components to do that business are going to come down. And it might not be highly investable now, but it's definitely like a good promising frontier technology. So again, I think that, different investors are taking different approaches. Some investors are looking for best in class. So if I was going to own fossil fuel companies, which would be the ones do I want to own? The market's starting to shun, more indebted companies, and favoring companies that have a stronger balance sheet. But the market has, doesn't like ExxonMobil because it doesn't see any, big pathway and technology for that company. So I think that unfortunately today in the energy space, it takes research. There's not some blanket solution where you just pick a class of companies, the way markets have done in the past, where it loved the shale companies in 2010 to 2014 until everybody lost all that money afterwards, in the downturn. So I think it really is going to take real market research, and it doesn't lend itself to the index approach. But the point about the index, which I think that people are starting to see, is that the oil and gas is only like it's less than 3% of the S&P today. And so the need to move it out of your index, your passive index, seems to me lower because it's a less important percentage of the index, and therefore the movement is going to be less impactful.
So in effect, what I think part of what you're saying is that something has fundamentally changed. Like we're not going back to a world in which fossil fuels are dominant or even necessarily a meaningful part, certainly of the S&P, not necessarily, and at some point, not necessarily investors' portfolios, full stop.
Well, I think the real challenge here is that, because the industry is being capital starved and people are not making investments, and on the national oil company side, because national governments are also constrained in finance, in Mexico and other places, we're definitely going to see a commodity move up at some point, depending on economic recovery. When we have an economic recovery, this sort of lower money going into future spending is going to matter. But from an investment point of view, I think the question then becomes, well, is that for a year, 2 years, 3 years? How long can I expect to have a healthier oil price? And will a healthy oil price just bring more investment in clean technologies because the price of oil is high? And so I think investors are looking at different ways to capture that volatility. And I try to tell investors, if you're inclined to underweight energy, fossil fuel energy, or you're inclined to divest, then I think as a broad portfolio investor, you might want to do a commodities long short fund. So if there's an uptick in the commodity cycle, not this year, but in the future, then at least you're quote unquote hedged, in the sense that if you have a commodity upturn, if you have something in your portfolio that'll allow you to capture some rents when oil prices go up temporarily, you're not quote quote missing the boat, but you're not exposing yourself to some long-term trend.
That makes sense. So I do want to ask you about the election and the impact that that's going to have, but I also want to keep on time. So I'm going to bring in the rest of our panelists at this point, and maybe we can make that part of the broader conversation. So if our panelists can all turn their cameras and their microphones on, and introduce themselves. So if you can just briefly say who you are and what you do. Albert, let's start with you.
Hi, everyone. My name is Albert Lee. I currently work for the University of California Investments Office, and I help manage the portfolio, the real assets portfolio, with my partner, John Ritter. It is a $3 billion portfolio focused on infrastructure, natural resources, and diversifying strategies. We manage broadly the investments for the UC system, which includes the 10 campuses, 5 hospital centers, and 3 national labs. And overall, we manage roughly $130 billion that is comprised of an endowment, pension, DC plan, and working capital.
Thank you. Michelle, let's go to you next.
Hi, I'm Michelle Levinson. I'm an associate at the Cadmus group where I work on strategic electrification. So I'll engage with utility and government partners to support their decarbonization efforts in terms of both technical developments as well as in terms of the policy side. And a fun note is I previously was working in research at one of those national labs that Albert was mentioning. So I'm really excited to be part of this panel.
Yeah, we're very overrepresented with people who have ties to the UC and UC regions in some ways in this panel. That was not deliberate, but obvious happenstance. Rob, let's go to you next, and then Kathleen.
Sure. So I'm Rob Day. I'm a partner with Spring Lane Capital. I've been, you say clean tech, but sustainability, VC, PE investor now for going on 16 years. And at Spring Lane Capital, we invest into small scale infrastructure, really catalytic project capital for all of the distributed sustainability solutions across energy, food, water, waste, and transportation.
And Kathleen?
I am Kathleen Kelley, one of the co-founders of High Water Women. And I have spent most of my life as a portfolio manager in commodities, and recently have transitioned to helping asset management firms and oil companies and gas companies and other people that have exposure to commodities, understand the fundamentals and manage the risk.
Great, thank all of you for being here. So Kathleen, I want to start with you. We had a lively conversation when we were doing the prep session for this discussion. And tell me sort of how you view the energy market and how your perspective on how this plays out potentially differs from the way that Amy sees it.
I think a lot of what Amy was saying, I agree with. I think that, commodities are cyclical, and I think what's happened with the pandemic has shortened the commodity cycle and also exaggerated it. So I think we've seen much lower prices than we thought we would ever see. Obviously, crude oil prices went negative, and we're going to see much higher prices in the near future, sooner than we had previously thought. The oil and gas sector has been starved of capital for a while, as Amy was mentioning, and this has just made it worse. So I think that a lot of production is not going to come back, and I expect that demand will recover fully in the near future. Jet fuel obviously will be much more difficult, but I think gasoline will make up for a lot of that as we all find our cars to be our safe space and drive more. So we're probably on a net basis going to see oil demand come back pretty quickly, and supply won't be there to meet it. So higher prices. The question then becomes, what do investors do in that scenario? Because the sector has become so small, and do traditional investors in the space come back despite the ESG environment? And I think that they do, because I think, everybody needs energy. That's the one input into everything we do. And I also think that, while renewables are an important part of going forward, providing energy consistently is a reliable energy is another important part. And to do that, we need fossil fuels for the medium term.
So, and Amy, I think your point was in the conversation was, yes, prices might come back for a little bit, but by the time investors move so slowly that they're not going to turn, their cruise ships around within that sort of window of sort of volatility. It's kind of like a climate versus weather.
Yeah, Yeah, I mean, I think the question is, you know, how investable is the space to me if I'm a large institutional investor? If I'm an active manager, you know, am I going to just rush into the commodity cycle and feel confident that I'm going to know when to exit? And, you know, you have the cycle, you have the possibility that the US sector, if they did get access to capital, is going to, you know, can produce volume in a pretty fast order. You know, my sense is people talk about, you know, costs and all these things. I see the sector as moving to automation increasingly in the next tranche. If they do get capital, you know, sometime down the road, they're going to move ahead and they're going to use automation. And therefore, they're going to be faster and leaner, since personnel is a big, what makes everything so expensive. And then also, I think the challenge really is that you have a lot of oil. I think there's a debate. Okay, so I'm on one side of the debate. I'm sure Kathleen and Rob might disagree with me. I know there are others that disagree with me. So, you know, everybody says, well, we understand, you know, jet fuel is definitely not coming back in the next, you know, 2-year horizon. And I did remind people after September 11, it was actually 4 years before US travel domestically went back to normal. So, and that was kind of a different thing. But anyway, if you look at the fact that you're going to have these technologies that we were projecting and modeling were going to eliminate some oil demand, whether that was telecommuting, whether it was a breakdown of global supply chains, so you'd have less trade by ship, lower freight, therefore, than was expected. You know, today it's Climate Week. You're seeing all these announcements. Unilever announced today that they're going to eliminate new plastics from their supply chain, in the sense that they set these targets for how much they're going to use only recycled plastics. So there are all these sort of structural things that were coming, that were going to limit this growth in oil demand that the industry had projected for itself. But now they're going to happen faster. And in my opinion, they're going to happen faster, partly because COVID just set the industry in a different course, but, you know, partly because digital is becoming so accelerated through all this, you know, lockdown, that people's acceptance of digital technologies is going to go up. And we're going to see a reshaping of cities where Kathleen is correct. We're seeing more people commute by car. But, you know, what's the permanent change going to be? Is it going to be that people, you know, because people are actually not buying new cars, and therefore all the manufacturing and demand and emissions that goes into car manufacturing is actually falling. And the question is, where will we end up? And so if we have a delay in the number of people who buy a new car for 3 years, that's going to be bad. But on the other hand, 3 years from now, maybe there's going to be a much better slate of electric cars for people to choose from if they want to go in that direction. And the ride-sharing companies have committed to electrification. So again, could make a big difference 3 to 5 years out in a way that's hard to project.
I want you to hold that thought on cars and electrification for a minute, because fortunately we have somebody who's an expert on that and has been doing work on it. So I'm going to ask Michelle about that in a second. But before I do, I want to ask Albert, you know, as a large institutional investor and also somebody who, you know, personally has a long track record and experience investing in the fossil fuels and the renewable space, how do you see the world going forward, and how do you think about this as an investor?
Sure, thank you, Imogen. And to frame some of my comments, maybe I'll expound upon my role at the UC. So we invest typically the real assets portfolio in the private markets. So we're typically investing in funds, long-dated funds, which are 10 plus years, lockups, and co-investments. So that's kind of one from a structural perspective. I think also to frame kind of my background, I'm also a recovering oil, gas, and coal investment banker. So I I've kind of been in the space for quite some time. And look, I think it's an interesting bunch of points that were made, and maybe I'll use a quick case study for what we've done at the UC. And this is actually a thesis that Amy and I actually worked on close to half a decade ago at this point, just from an institutional investing perspective, to really kind of understand where the markets were going and how we wanted to position ourselves. Not really just, you know, talking about it as ESG per se, but to say, hey, where are the risks embedded in the returns that we're trying to achieve? And that's ultimately all we're trying to do. One interesting point back in 2014, 2015 was we went out to a ton of our partners in Houston, and we asked them, and you know, Kathleen could probably speak to this as well, is, look, what do you think the commodity prices will be looking like? And this is right after the downturn in 2015. What are prices in oil and gas going to look like, you know, in the next 6 months, 12 months, 3 years, 5 years? Now, as an institutional investor going into a 10-year lockup fund, you know, when you have almost all your partners saying, hey, if I could tell you what the price of oil will be in 3 years from now, I wouldn't be doing this job. I would be a billionaire sipping in pina coladas somewhere else, right? And ultimately, that was a great joke at the time. But for a long-term investor such as UC, we said, hey, look, like, no one can really give us a straight answer as to where prices will go. We've realized that we've moved away in 2008 and 9 from a peak supply issue to a peak demand kind of mindset. And so therefore, you have OPEC, which is losing power greatly. You have a swing supplier in the US with high technology, which is basically horizontal drilling, so they can come on and off very quickly. So you have a new market participant that will bring prices within a certain band and said, okay, well, we believe we're not going to predict where oil prices will be or commodity prices will be. We're not that smart, and neither of our partners. Given the volatility and how range bound it will be from now until 10 years from now, does it make sense for us to invest in, let's say, an upstream oil company that will have a 10-year lockup? And ultimately, it was a pretty simple thesis that said, we're not smart enough to say we can hit a 10-year window that will specifically be able to outperform someone like a Kathleen who's at a commodities fund, who will be able to take those gyrations and those opportunistic bets where things will be low at one point and sell at the correct time, because we don't have that ability, right? So a secondary sale for a fund, it could take, you know, a year. And so because of that, we decided at that point to say, hey, maybe it doesn't make sense. Maybe we should look at more liquid investments in order to be more opportunistic about it. But at least from an upstream energy perspective, a private vehicle doesn't make sense. So that's case study number one. And I think case study number two is talking broadly about, you know, coming into investments as an ESG investor or an impact investor. And I think it's a little bit of a misnomer. I think we all have to think about ourselves just as investors. And ESG is really about understanding and quantifying risk. And you're talking about what are the returns that I'm receiving for the risk that I'm taking. Now, back in climate opportunities 1.0 versus climate opportunities 2.0, I don't think a lot of people really understood the incumbent and how entrenched the incumbents were and how much infrastructure they had, you know, invested already. I think that kind of has washed itself out, and people have understood that, hey, I need to be cost effective. I need to understand, hey, if I'm not thinking about the type of cost impact that my affluence from my water or the carbon impact of burning X or manufacturing Y is not going to hurt my bottom line over time, then I'm actually not really capturing the return for the risk that I'm taking. And I think currently a lot of the high hydrocarbon intensive reserve companies are starting to realize that. I mean, like Amy said, they've probably looked at their balance sheet and they've made a lot of FID commitments, and they say, what is my wellhead return compared to the returns I've had in my, let's say, $1 billion clean tech strategy versus my $40 billion offshore drilling strategy? And they've probably seen the return on capital has changed. And I think that is an extremely strong incentive for people to start moving to where capital will really be put to work. So I think that, you know, as people will be able to take that opportunity to say, am I pricing this risk correctly? And the people who really jump on that earlier will be able to invest ahead of that wave as opposed to behind it.
And I know you've been talking to quite a few asset owners and getting sort of a snapshot of their thinking on these questions. For the most part, do you think people are thinking the way you just framed it, or do you feel like you're an outlier? And because one of the issues that you have the sort of the ESG people, and then this actually holds for both the sort of traditional investment people and the ESG people who are coming at it from a very different angle, I would argue.
Look, the short answer is traditional real assets portfolios typically have been, and endowments and foundations have typically been focused on kind of upstream and midstream oil and gas, metals and mining, legacy timber, and maybe some ag, in order to really protect against inflation, have some uncorrelated returns to equity and fixed income markets. And you know, I think the E&F and institutional investment world has actually been a little bit slow to implement. And you know, and in general, I think real assets portfolios are undersized in the sense that if they are supposed to protect from some shocks in inflation, they just haven't sized appropriately. So if there is a large spike in commodity prices, I'm not sure a 2 to 3% allocation to real assets really protects your entire portfolio from that inflation shock. So that's a whole other asset allocation discussion that we can have. But yes, I mean, there are a lot of forward-looking endowments foundations who've been talking to their boards where they've started to realize that these investments that they've just done for decades, they've had long relationships with, they have to really question them, and they're really starting to shift. And they're starting to think, hey, what is the next wave of sustainable investing, of infrastructure investing, where it's going to be technology enabled, that is going to define what the world will look like in the next 10 years. And so they have to reshape. But I would say that, for example, that the UC is much further ahead of the curve than some of the other peer foundations that we spoke to.
So just to toot my own horn for a minute, Imogen, so cards on the table, I was an advisor to the UC as a UC professor for several years. And some of the analysis, you know, Albert's laid out, but some of the broader analysis he didn't go into. So what my research has shown is that there is no longer an uncorrelated return between oil and gas commodities and the S&P 500. Everything's moving together. The high yield bond market is highly exposed to what happens to the shale companies. They're a big portion of what moved that high yield bond market up and down. And so one of the things that I saw in my work with the UC, especially on asset allocation, but even on just assessing ESG risk, is you have a lot of attention that came from the NGOs about your public equity portfolio and your index and whether or not to take, you know, an Exxon or some fossil fuel company out of your index. And people completely ignored the exposure they had in high yield bonds. They completely ignored the fact that someone was locking their capital down for 10 years into oil and gas or into coal. And they didn't look at what they were doing in real estate, which is highly influenced now by climate change. And so one of the things that I advised the UC, which they were very progressive on, was to, you know, don't get so hung up on the fact that someone's marching around telling you to take something out of your index. Like, you need to focus on, you know, evaluating how ESG risks are going to affect things that are less liquid, especially real assets, 200% real assets, but also to this day, you know, people are overweight energy and they don't even realize it. It's because they have a certain percentage in high yield and they have a certain percentage here and there, and they weren't understanding that the correlation was now direct. And so whatever risk they had, they weren't hedging against the S&P, they're just doubling down on the risk. So for me, the next big thing, you know, besides whether or not, you know, we're going to have a commodity cycle and how that might affect these different, you know, energy buckets, right? You know, no one is evaluating properly, in my opinion, the sovereign credit market, right? So again, you have this big exposure to sovereign credit. And, you know, are you aware that Petrobras has almost $80 billion in debt in the sovereign market? Are you thinking about the fact that Pemex, you know, has $6 billion coming due this year, but there's another, you know, 24 billion behind it by 2024? I mean, there's a lot of risk out there in the sort of national oil company sector that's not priced into the market.
Yeah, no, I very much agree with that. And I think there's a really interesting debate to be had there about how has the divestment conversation been useful in terms of raising awareness, but potentially negative in terms of truly understanding what the risks are. But again, I want to go to Michelle, and then I saw Rob nodding vigorously when Albert was talking, and I don't think it's just because he has to suck up to him. So after that, I want to go to Rob and get his perspective. But Michelle, you know, we talked about the automotive sector and how transportation behaviors are going to change. Can you speak a little bit to the research that you've been doing around how you, particularly obviously in a post-COVID world, you expect, or a current COVID world really, you're seeing those transportation behaviors change, and then what that means to investors, and potentially sort of your frustration about how investors use data and potentially look through the look at things through a rear view mirror instead of forward looking. So just a few things to discuss.
Yeah, and I've been like noting down as we've been talking. I underlined uncorrelated here, so certainly a lot of really interesting points being made in terms of the trends, specifically in the transportation sector. I think what Kathleen was speaking to is right. The near-term changes in behavior, we, in the last 10 years or 20, have expected big changes in how folks would be working from home, for example, that might not have materialized. We have seen urbanization trends that may be paused or may reverse. So those near-term and even maybe mid-term trends matter, and it's a question of what's the horizon that investors are thinking about. And the other thing that I think really influences that horizon is going to be the policy context in which, and I'm a policy person, so I'm going to keep coming back to that, but the policy context in which consumers are making decisions, and also the corporations that are serving those consumers are making those decisions. I just did a big workshop with bunch of experts and state government folks in New York, and we came up really with 3 risks that we see as the kind of top drivers that will influence the state's decarbonization pathway. One was federal policy, which I think is no surprise to anyone. The second was mobility options. So when we're talking about autonomous vehicles or the little e-scooters crowding the sidewalks, the consumers are making choices based on options, right? And then the last thing, of course, is consumer behavior that is really closely correlated with the choices that they're given. But what sets the bounds for that choice set is going to be the policy context. And while federal policy is really important, and I know I would love to hear from everyone else some insights on how they think November will affect these markets. The fact is that the states are already moving, and the local governments and regions are not waiting for federal government. And so when the state of New York or California look to highlight federal policy as a key risk, it's not it's not determining the pathway for the state, it's determining the cost. So I guess it's really interesting to have folks dig into the timelines that we're talking about here. And I think investors really need to keep that in mind when they're looking at these trends.
So, and I definitely want to come back to the November question and what impact people think that will have, and if, to what extent does the federal policy not matter if the states make their own decisions? And then the question also presumably becomes, what will the impact of a more conservative Supreme Court be, right? In terms of blocking things, if you really want to get depressed. But Rob, again, as somebody who has been in the venture capital and private equity space in the clean tech world for a long time, how are you seeing things change, and why were you nodding your head so vigorously in agreement with what Albert was saying?
Yeah, and it's just to be clear, it's certainly not because I'm sucking up to Albert. I would never do such a thing. Apropos of nothing, I really like the decor of your room, though. That's like, you should submit that to Rate My Room. That's really, really good.
He's got the plant in the background and everything.
I know, it's perfect. But again, just to reiterate, I would never suck up to Albert. Anyway, I was nodding my head actually because, we're seeing much the same thing from the perspective of the, direct investors into these markets. What I think we're kind of seeing is this, difference between the short term and the long term. I completely agree with Kathleen that, it's likely that through the, shortening of these mostly supply cycles, that we're going to see, probably a near-term spike. I also, though, agree with, what all of my fellow panelists have been talking about, which basically I would describe as a bit of a changing of the guard. Yes, there are ways to play the volatility in oil and gas, where smart investors are able to, if they're structured the right way, take advantage of these very short-term swings in prices. But when I've spent a lot of time talking with some of the institutional investors who've backed our fund, or with large family offices such as the CREO syndicate that my team in our previous incarnation helped spearhead the growth of, looking across all of those large investor types, what I see is that whereas 10 years ago a lot of these investors would have viewed oil and gas and traditional energy as being sort of the safe choice, and renewables and clean energy and all of these alternatives around electric vehicles as being new and therefore risky. The type of volatility and the short swings that we've been seeing, I think, have taken the bloom off the rose. Again, it's not to say that people can't make money in those swings, but it really does feel like for a lot of these institutional investors, especially those with a long-term view, they are viewing the world the way Albert was talking about, when it's like, hey, I need to put money at work into things that are framed in terms of 10-year funds. With that kind of price volatility, why would I be interested in that when on the other side, we have these types of projects that have very predictable yields and have very predictable inputs and outputs if they're structured correctly. So at least from what we're seeing tremendous interest among institutional investors at getting into this mega trend around sustainability. The challenge is a lot of the choices that they would want to see barely exist from that perspective, especially on the private market side. If you are a large Canadian pension fund, for instance, and you need to write essentially a $100 million minimum commitment to a GP of whatever form, just because you're of such a size, and whenever you make a commitment to any GP across any asset category, you're basically looking at that kind of minimum, then you're really challenged in thinking about how to play this from a venture capital perspective. You're really challenged in trying to think about this in terms of anything really other than large format renewable infrastructure. And that what we're seeing is that there's a great hunger among these types of very large players for trying to get in, and great frustration that they can't. So I think we're starting to see the emergence of a number of new investment strategies by GPs across asset categories, whether it's real assets, whether it's private equity. We're certainly seeing the rise of this in the form of clean energy and sustainability oriented SPACs right now. But you know, an emergence of a whole bunch of different investment strategies. And the one optimistic note I'll leave it on is that it feels like we're finally starting to get to this robust capital ecosystem around sustainability that we really lacked, you know, over a decade ago when we saw that last bubble in clean tech private markets, where it was basically just venture capital, large format infrastructure, nothing in between for the most part. But now we're starting to see the emergence of a much more robust capital ecosystem, like frankly, oil and gas has enjoyed for a long time now.
But it seems like there is a pipeline problem there, in that you still have a unwillingness on the part of asset owners to, you know, invest in first-time funds and things like that. Like that,
Yep.
To your point, that there aren't so there isn't the infrastructure that is needed to sort of bridge that gap between sort of venture and, you know, if the fund vehicles that are needed don't exist, how do we finance those vehicles when so many asset owners are unwilling to step in and take that risk? And I want Albert to answer that, because I know the UC has done some of that. And then I'm going to go to Kathleen and ask her about the election, and then Amy and ask her about the election. So Albert.
Look, I think Rob has definitely picked up and highlighted an interesting development and as well as a challenge. I think the ecosystem is still a little bit barbelled in the sense that there's a ton of capital on the very large infrastructure side for, let's say, operating wind and solar, and then the venture capital side, which is very early stage battery tech, you know, app layer stuff for distributed generation, wastewater projects, which are kind of the 1 to 2 million. And so you have this middle ground, right, where there's the project finance, there's some really interesting growth equity opportunities that have really started to pop up. I think a lot of traditional energy managers are also starting, quote unquote, energy transition funds. They are really trying to say, hey, look, there are adjacencies to our current strategies. And yes, it's going to take time for large institutional investors to really focus on the space, because ultimately, from an allocation perspective, it's competing against other regular way, let's say, private equity services, technology opportunities. Now, you could say, hey, look, this could potentially be uncorrelated, so you don't have to put all your capital into a large tech growth equity fund. And so you're getting uncorrelated type returns, or you find an opportunity that's really focused on resiliency. So something that we haven't talked about isn't just about climate change and how, you know, we're shifting from, let's say, natural gas to solar plus storage. But for example, climate change is affecting us today, right? So how is that going to impact insurance companies? How is that going to impact transmission in California? Like how are we undergrounding all that transmission? All these are big, huge infrastructure and private equity questions, because a lot of public funds may or may not be there. And so you have, really interestingly, a lot of family offices stepping in, foundations stepping in, and then you have a really interesting part of blended finance, where you have some first loss risk capital coming in as well, which I think is a huge structural advantage that really needs to be integrated. So yes, I think the full cycle of funding in the, I call it the new energy space, is really maturing. It is up to institutional investors to really roll up their sleeves and be able to get there. But we're very much first, second innings, because people are still trying to understand, fund one, fund two, new teams, people working together for the first time. And that's the added layer of complexity to what we're talking about.
Rob, is that your experience? Is it getting easier?
I think we're seeing a lot of these large institutional investors who are interested in finding these new strategies. I also think, you and Albert are completely right that it's very hard for these large institutional investors to place a very large bet on a first-time fund. So we're in this sort of chicken and egg period, but the encouraging thing is we're starting to see some of these funds go out there and raise a fund too. Go out there and raise follow-on capital. Some of them aren't structured as funds per se. I do think it'll be easier. There's almost a race to see who can go out there and demonstrate some good early results with their new flavor of investment strategy. And then at least from our perspective, it's been made very clear that there's great hunger for, fund twos after successful fund ones in all this space. The worry for me is that because there's so much pressure to put dollars into these strategies right now, that we are starting to see some high valuations. We are starting to see, a lot of growth capital come in to platforms that aren't necessarily ready for that much capital or that high of a valuation. And in that respect, I do worry that, we're going to see some flameouts before we see some successful fund ones, right? I do worry about some of what's going on with SPACs, and I'd be curious to get, my fellow panelists' perspective on that. But I'm seeing some paper valuations that are just really nosebleeds. I do see, once again, some very large venture capital structured growth rounds where all that super expensive capital and those high valuations are basically just being used to fund steel in the ground, and that has not historically worked. So I do kind of worry that we are still subject, because it is really, from a large institutional investor perspective, still a shallow pool in which to swim in, that we're going to see some, to really mix my metaphors, some flameouts early. That could once again dampen enthusiasm, or at least make people feel cautious again.
So I think that again, that seems like a good opportunity to bring in this question of the election. And Kathleen, if we have, how do you see the election playing out in terms of these markets? And B, in the event of presumably a Trump win and a rally in fossil fuels, does that result, what happens to these high valuations?
Okay, I'm going to defer to Amy on a lot of this, because on the political side of it, my insight is fairly limited. I can tell you what I think will happen in a Biden administration, but I think it's not about, in my view, it's not about what happens in the election. It's about what happens to demand. And I just want to make two points. One is that short term, I think COVID, the question is, does COVID increase your per capita energy consumption or decrease it? And I think it increases it. I think it increases it across the country and across the world. And that's, a lot of it is transportation, but it's just the way that we use energy. And so I think that demand is going up because of this in the short term. I think in the longer term, it's really hard to tell what the next technology is going to be 10 years out that's going to drive the way that we move around. And the chief technology officer at Aramco always tells this story that he says 10 years from now, we'll probably all be using flying cars, and there's no way you can power those by batteries. So, we have to really think, are we just looking at the technology that exists right now and assuming that it has this trajectory going forward? Or is there something that's going to totally replace it? And I think it's important to try to move cleaner faster. And the way to do that is with the internal combustion engine and making that more efficient and cleaner. But that's just my opinion. I'm going to defer to Amy now on the politics.
Amy, what is your view on?
So I tell people, there are things where the election doesn't matter, and there's things where the election matters, right? So one of the things I tell people is to say you're a midstream investor, and you're thinking that, a Biden election might be worse because there'd be more emphasis on, federal methane policy and so on and so forth. What I tell people is, under a Trump win, the lawsuits around pipeline operation and pipeline expansion or new pipelines is probably going to intensify, right? And that lawsuit risk is actually what's been, is a big risk out there for the midstream sector, And, trade war, big risk to LNG, US LNG. So, the idea that somehow a Biden win makes a big risk to oil and gas that is different than the Trump win, I question that a little bit in the sense that you have to look, what a state's doing. Another example, doesn't matter who wins, New England all the way down to Virginia is greenlighting this giant deep water offshore wind. So maybe it gets easier to do under a Biden administration because there'll be more stimulus dollars and subsidies, federal subsidies. But the bottom line is it's happening one way or the other, right? So I think that the big ticket items that would happen for Biden that I see as sort of immediate, right, are number one, US is back in the Paris Climate Accord, right? With all the ambition that might bring. On top of Europe having a green stimulus, South Korea having a green stimulus, China, as I understand it from talking to people, is going to announce in their next 5-year plan a much bigger commitment to green stimulus. So, a Biden win would accelerate all of that and make it, and sort of like amplify it because the United States wouldn't be rowing in the opposite direction. The other thing that could happen in oil is, does US sanctions policy change under a Biden win? Now, I am not one of those who believes that the Iranian oil comes immediately back to market because the Iranians have a habit of stepping on themselves even when people are willing to negotiate with them. So I don't think there's going to be an immediate Biden shift. I think that there'll be a tempered effort to, gather up with Europe and think about how to restore some kind of arrangement with Iran. That'll take some time, but maybe 6 months or a year into the new administration, if it's a Biden win, we could see some Iranian oil losing, having sanctions come off of it. So you might see some movement like that would actually loosen up the oil market even more. And so I think it's sort of more of a mixed bag than people see it. And I just, when I talk to people about investing, I think you have to invest along the trend line, but a Biden win, again, in my opinion, is going to be good for hydrogen. You're going to see maybe more US push into the hydrogen space with federal dollars. So, you get some, new startups or companies talking about hydrogen planes or talking about hydrogen as a backup for wind. That's already taking off in Europe. You might see a little bit more movement in that in the United States going forward if you had a Biden win.
I just wanted to do real quick interjection, sorry, but just, when we talk about this, we naturally tend to frame this in terms of US politics, but, to your points and to the points of a lot of, all about, sort of macro trends, I think, China's just now announcing that they're going to aim for, carbon neutrality by 2060. There's a lot of, macro movements here that are beyond US politics.
And let me mention, because I mentioned the NOCs, PetroChina, followed BP and made an announcement that it's going to near net zero by 2040, and that it's going to shift its capital investment to renewables and geothermal and hydrogen. So, so you are seeing these changes where the world is, very divided in terms of, some countries are just really, digging down on fossil fuels and trying to protect the jobs in fossil fuels. And you see other countries that are thinking they want to grab the sort of green future and make sure that they're best positioned in a growth market. So, those distinctions are ones that investors need to educate themselves about, on many different levels.
Albert, what about you guys? Are you putting off making investment decisions until you see what the outcome of the election is? Or does it not make a difference to your long-term projections and therefore it doesn't really matter?
Again, if I could predict those things, I would be in probably a different line of work. But ultimately, what we're always trying to do is position ourselves where there are secular tailwinds. So, for example, when you think about just renewable power generation and development, as much as the federal policy today and federal government has really put a big damper on anything, ultimately it's the state renewable portfolio standards that have driven demand across the Sun Belt, across, basically the entire United States. So it becomes a state level decision, and it's a pretty bipartisan push, for example, where you're creating jobs really in offshore wind, onshore wind, solar plus storage. You're creating a new set of jobs. So there's a lot of support there. So we think about placing our investments or positioning where we think that ultimately it shouldn't matter where things end up from a political perspective. And I think Rob made a really great point. Again, we're thinking about if there is a reset post, COVID in a new normal or next normal. You're already seeing this in Europe. You're seeing this in Asia. You're seeing this from the sovereign wealth funds. They're talking about not just monetary policy, but fiscal stimulus, right? How are we going to reshape infrastructure? How are we going to create new jobs? How are we going to do all these things to bounce back economically? And a lot of these things are driven by investments in things that are critical to, again, infrastructure and the backbone of how we'll rebuild our economy. So that's how we try to position ourselves. Now, is it going to be perfect? Probably not. But that's how we try to view the world as bipartisan and secular as possible.
So I'm going to open this up to questions from the audience if we have any, if people want to raise their hands. But we did also have some questions from the panelists. Amy, you had flicked at this question of midstream oil and gas, and I think part of what you're getting at here is that somewhere where investors are underestimating the risk or maybe have too much exposure?
Are you asking me the question?
Yes, I'm starting with you.
Okay, so, hearkening back to the sort of Biden risk, clearly, if there's going to be increased regulation of methane leakage, then I think investors are underestimating that risk in U.S. midstream.
But in a sense, it sounds like what you're almost saying, this would be a very Bob Litterman point to make, that in a Trump administration, that risk potentially actually goes up. Because if everyone's like, woohoo, it's all going to be fine, then in fact, the risks of litigation and the other risks actually increase. Like sort of.
So I think that there's a high risk in the space, and you're seeing some companies. I think in the next couple of weeks, you're going to see some of the big operators in the Permian are going to announce that they're going to have methane leakage targets, that they're going to strictly try to bring down their methane leakage. And you've got pipeline industry companies that are actually actively, just a very few, actively looking at, which is already taking place in Europe, the technicalities of being able to inject hydrogen into their pipelines to clean up their emissions from their overall mix to utilities. So I think it's a moving space, and I think there are companies that are just, digging down. We're going to keep flaring, we're going to keep leaking methane, and we don't care. And those companies, they may or may not be disadvantaged depending on the election. And like you said, they could be subject to shareholder complaints and pressure. They might be subject to lawsuits. But in addition to that, you have the added pressure that Europe might go, if say there's a Trump victory, Europe might go ahead with a carbon border tax, and US oil and gas could be targeted. And in the competitive market where demand is sort of falling off here and there, the US industry, does not need to have this extra pressure of being targeted as a dirty export. And so I think the industry really has some problems going forward that it's not addressing. And you are going to see these sort of best in class companies, I don't know if I should mention a name or not mention a name, that are going to step up to the plate. And I think there's 2 or 3 companies I know for a fact you're going to see announcements in the next couple of weeks, and it'll be interesting to see if investors respond to that.
Kathleen, I saw you nodding your head at sort of some of what Amy was saying. Does that match up with sort of your analysis and thinking?
Yeah, I think you've seen, some companies talk about, how atrocious flaring is and how, it's a scar on the oil and gas industry. And so I think that you will see people start to make these steps in the right direction.
I'm disappointed. I was hoping for more disagreement between the panelists. Michelle, what about Rob? Had a question for you. I don't know why he couldn't ask it himself, but we talked about how in a Trump administration, absent the US going back into Paris, absent there being federal leadership, we've already seen over the past 4 years, particularly states like California and New York, and even municipalities like New Orleans step up and take actions. What is left behind when you don't have a federal response? What are the holes in the grid?
Yeah, thanks. It's a really good question, and I think there are some holes. I guess one piece of it is just the cost of transition is higher. So whereas it might be more distributed if there's policy at the federal level. So an example would be here in California, the California Air Resources Board passed something called the Innovative Clean Transit Rule, which basically mandates complete transition of the transit fleet. So all public transit buses to either electric or fuel cell vehicles by 2040. And this transition initiates purchase no later than 2026 with additional incentives. So, okay, great. California has this plan and it's going to push transit within the state to increase demand in the market, right? That is going to have spillover effects in the market as a whole, but it is bounded by federal rules around Buy America policy, because one of the key leading firms is BYD, which is a Chinese corporation. So I think that's a really clear example where inconsistency between the levels of government adds cost to the transition that is coming. I guess another thing that I do want to point out would be the cost of innovation and the upside of research and development investments. So that's where we see I know about studies and research that have been pulled back at national labs, and that slowdown in scientific knowledge development or the privatization of that is a cost that all of the companies and economy are bearing. So there's a bunch of holes to your point, Robert. But I think that it's like they're just larger bumps in the road, but the road is already set.
I wanted to lob in on that though too, in that, well, I totally agree with everything you just said, Michelle, from a deployment perspective, where we need the capital that is the trillions of dollars that's really just waiting, to be given permission to come into this sector. The very Byzantine nature of this patchwork state level set of regulations and incentives does stymie that to a large extent too. So yes, that does create opportunities for nimble players, such as we've already seen, in the solar space, to be able to hop from one, okay, now New Jersey's the hot place. Okay, now community solar in Massachusetts is the hot thing, and to hop around and hop around. But if you are sitting, at a very large institutional investor, looking to try to come up with a coherent strategy to put $1 billion at work into this thesis, that doesn't sound very attractive to you. It sounds very nichey. It sounds very unreliable. So that's where I think some federal level consistency and support would be invaluable for unlocking a lot of the capital that we need to see deployed into this.
Yeah, I think that's really a good point. I think there's two pieces of it. One is I'm in California, so I'm very biased, but we are a huge part of the global market.
You're your own nation state.
Yeah, and so that's one piece of it, is we can think about the spillover effects are really important. And then the other piece, I think, is the principle of this federated system of government is that these states are the laboratories, but the laboratory is eventually supposed to be mainstreamed. And so we've got lots of laboratory here, and we do need federal leadership to scale. Yeah.
I think Amy also raised a good question in the chat, which is, are you seeing states and municipalities reduce their funding to their renewables programs because of COVID-19, and how do you see that playing out going forward? For example, I've been doing a lot of work in the good state of Hawaii, and they're a state that's going to be very severely impacted by, they have these very ambitious renewable goals. They're going to be very impacted by COVID, obviously, because so much of their revenues come from tourism. And now there are all these host of other questions that they also have to deal with. So how do you see states and municipalities dealing with that? And what should investors take away from that? Michelle, that was for you.
Oh, sorry, I thought I misheard. Yeah, I think it's a very real challenge. I don't see changes in the trajectories of the policies. And so one thing would be, is the cost of transition lower now? And the cost to borrow, for example. Another thing that I would think about is taking Hawaii as an example. Yes, the income stream is really burdened right now, but a lot of those services that tourism industry was taking were reliant on the fossil fuel economy. And so it may be easier to make transition at a time when there's already disruption.
Amy, do you have any perspective on that from the people that you've been talking to?
I was on a panel a few days ago, and there was someone who works with cities, and they said that the cities, are really burdened now to shift dollars into, social services and other kinds of services. And, you also have this big question mark in cities like New York and San Francisco, whether, is it just some tiny little portion of people who are moving out of those cities and they're only going to do it for a short period of time? Or are we really going to see in the United States and elsewhere, a slowdown to the urbanization trend? I think I would argue that you're probably not going to see a slowdown to the urbanization trend in places other than the United States. And so maybe we need to be a little less, ethnocentric on that. But in India, you've seen this sort of return to rural communities. So I do think that there's going to be some effort to try to think about what policies, hit every bucket. Is there some climate initiative that's also addresses health, that also addresses lower income populations, that those things are going to get green lighted first? And the sort of, I hope Michelle doesn't offend you, but coming from California, this kind of California-esque, I'm going to give $3,000 to some wealthy person to buy an electric car, and I'm going to give them a subsidy on a charging station, public charging station. I think those kind of policies are going to be a lot less implementable going forward. And so we're going to look for infrastructure or structural policies where I'm dotting several different I's with the same policy.
There's a reason I use the transit rule as an example. I think the equity piece is really important, Amy.
Yeah, I think it's going to be a much bigger piece going forward. And again, with the election, more emphasized on the federal level if Biden wins, but will still be a municipal and state priority, even in red states, if Trump wins.
So Drienne Brenner in the audience has a question. She wants to know, are these, we've talked a lot about, you know, large institutional asset owners, in particular Rob's friends, the Canadians. And also, you know, UC is, you know, what, 130 billion in assets. How can, you know, smaller asset owners, like, you know, particularly, let's say, small endowments or even, you know, ultra high net worth individuals, how can they take advantage of these opportunities and potentially manage their portfolio risk? Rob, let's start with you since you thought it was a good question.
Sure, yeah, and it is a good question. So thanks, Jan. What I can see from looking at my peers across the landscape, because we talked about this sort of first time fund challenge and the chicken and egg, and how do we introduce these new investment strategies to the market. First of all, for those who have the appetite to take on first time funds, you know, there's a lot of very credible first time efforts now. These are oftentimes experienced investors who have battle scars from the last time around, and new approaches. And I've just got a lot of friends and peers in the industry who are attempting first time funds and could really use support. But even for those who don't have the appetite to take on first time funds of any stripe, there are these new emerging strategies that aren't necessarily on their first time fund, but aren't necessarily at the, you know, $500 million size fund level quite yet, that would allow a large institutional investor to put, you know, $100 million in and still be 20% of the fund, which is oftentimes a limitation. What I see quite often is that because of this, there's almost like a donut hole. There's a lot of, you know, sort of angels and high net worths who are looking to put 6 figures, maybe $1 million or $2 at work into a fund. There's folks who want to put, you know, $20, $30 million commitment into a fund, but there's a real dearth of $5 million, you know, LPs out there. And for a lot of these strategies, they can be really, really valuable for helping fill out a fund that, you know, maybe they're doing some kind of innovative debt structure. You know, I'm thinking about groups like Winsale and the like, who are doing some really interesting stuff out there in these markets, and could really use limited partners at that level to help them eventually, you know, graduate to you know, larger and larger commitments.
You almost see this sort of smaller investors as being able to play a sort of quasi-catalytic role in terms of building the market.
Yeah, completely catalytic. I mean, you know, the way I think about it is we've got all these, you know, smaller funds right now doing interesting stuff. It's almost like the mammals emerging out of the, you know, the post-meteorite, you know, winter. And, you know, they eventually need help to be able to get all the way to the fully mainstreamed, accepted, you know, take from Wall Street. I mean, it's easy to forget, but infrastructure itself is not a very old asset category. And yet now it's just seen as like, oh yeah, that's what we do, right? So we need to help these newer approaches sort of graduate to that mainstream level. And whether that's GPs doing catalytic things, or like this good question points out, LPs being catalytic for those GPs, there is a gap there. Somebody needs to be, you know, the bridge to it.
Albert, I was going to ask you for your perspective on this anyway, but you raised your hand, so.
Yeah. I just wanted to chime in just very quickly. I think there's kind of two things that I just want to bring up. One is, you know, this opportunity set should just be looked at like any other opportunity set as institutional investors have done in the past. So I spoke to a colleague of mine and a different asset owner in Canada, and they really don't have that much, for example, Asian infrastructure exposure. And so they said, hey, look, what we ended up doing was we invested in a fund of funds that has a big kind of shotgun approach to Asia. And then we followed these few funds, and then we said, hey, we really like 2 or 3 of these funds. So I know, you know, especially in the institutional world, the fund of funds idea, or primary investment idea in a bunch of funds to get a portfolio effect really reduces the risk. You know, your dollar goes further, and then you can really find the winners and feed those winners over time. So I think that concept really kind of needs to be taken here if people are trying to mitigate a risk from an LP perspective. And that way you have this, you know, a feeder system where these funds can really mature and grow from that 100, 200, 300 million perspective to becoming those multi-billion-dollar, like multi-leg strategies. So I really think that, you know, every new quote unquote asset class or opportunity set should kind of, if there's ways to mitigate those risks. And I think people need to just, you know, again, I will mention this again, roll up your sleeves. And that's the second part of my comment, which was, it really takes sectoral expertise. So understanding power markets very regionally, right? So California is different from Texas, is different from New England. You know, what happens in the UK is very different from what happens in India in power. Understanding how gas is being priced around the world, global LNG, how that affects electricity prices, how does Permian oil drilling affect associated gas, which depresses gas prices in the US. Like all these things are interconnected. You need sectoral expertise for people to really understand how these things are connected, because if you don't understand those risks, you can't have those specific questions. So if you're dealing with a water utility or a waste management, you don't really understand the full supply chain of feedstock and off-takers, you're not having really good ability to diligence. I think that level of education is going to take time, but institutional investors, you know, with the help of the Rob Days of the world and the Amy's of the world, they're going to have to go out there and really, you know, it's going to be a long lead time, but I think it's going to get there eventually, so people can have really substantive conversations over time.
I think those were some really helpful insights. Alyssa is giving me the 1 minute countdown, probably now down to minus 1 minute countdown. So Albert, it sounds like we can just do a lightning round of, if you could say one thing to investors, what would your one recommendation be? Albert, it sounds like your one recommendation would really be sort of educate yourself.
Yeah, I think reach out to peers and you know, and really do that research and just take a lot of meetings, because I think you're talking to some of the smartest people in the industry, and people are willing to talk about it. And it's a really, you know, based on costs and, you know, economics, as opposed to pie in the sky kind of technology moonshots.
Rob, what would your one elevator thing to investor be?
Yeah, just embrace new models and recognize that in these sectors, because it is energy, food, water, waste, transportation, very physical things, as opposed to some of the other areas for investments. You know, quite often the existing asset categories and existing, you know, this is how it's done in venture capital kind of approaches aren't a great fit. So we need new models, which means investors need to embrace new models.
Great, thank you. And I'm sorry we didn't get to your SPAC question. I really wanted to. Kathleen?
Yeah, no, I agree with Albert. I mean, it's a pretty complicated space. And so I think, you know, understanding the fundamentals of these different regional markets and is just critical, so.
Michelle, thank you.
Yeah, I guess in addition to the research, it's recognizing the limitation of backward-looking information.
And Amy, I'm going to leave you with the final takeaway.
Well, I'm going to build on what Michelle said. So one of the things people do in the education process is you can internally, you know, clock some things. There are ETFs in some of these fields that have baskets of these new companies that people are looking at, and you can just kind of get a feel for where the performance is going forward, and just familiarize yourself with what's happening in the sector via the ETF space, or baskets that, you know, an MSCI or others put together. Some of the big macro shops have identified and are creating, Fidelity also, these sort of baskets of different kind of ESG performers, and, you know, just sort of, you know, use that data to look over time, comparing your own investments, underweights and overweights, and how these baskets perform in comparison, to give yourself some information to forge a new strategy. But forward-looking, not backward-looking.
Great, thank you everyone. This has been a really interesting and informative conversation. I feel like we could have kept going forever, and I apologize for my technology issues and barking dogs. Alyssa, do you want to have close us out with some final remarks?
Yes, thank you. I just want to say a quick thank you to all of our panelists, to Amy, Albert, Michelle, and Kathleen, our founding member of High Water Women, and thank you to everyone who was able to attend in the audience today. We have 2 sessions coming up in the next few weeks. They're on your screen. Please check them out. If you want to keep up to date on what High Water Women is doing and the conversations that we're having, you can always go to our website, and you can also become a member, which would be fantastic, as membership does underwrite the cost, help to underwrite the cost of what we do. And you'll also be connected to a great network of other investors and like minds who are in this space as well. Next slide. We also have, I want to thank our underwriters today, Treehouse Investments, who is also with us in the audience today. Thank you so much. TriLink Global and DWS, and of course, our members who are supporting us as well. Next slide. And that is all for today. Thank you again, everyone, for coming. Thank you, Imogen, for organizing this work, and along with your co-chair of High Water Women Impact, Drianne Benner, also in the audience. And we hope to see you all again very soon on our next session or over in membership. Have a great day.